Everything that is a function of interest rates is already broken because the Fed kept interest rates at zero for a decade, and real estate is hugely impacted by interest rates. First of all, residential real estate, people, when they shop for a home, they shop monthly payments, right? The actual price of the home is irrelevant. What they look at is, what are my payments? And that's how they get qualified, for these mortgages. And so when interest rates were very low, people could afford to pay a lot more for houses than they can afford to pay now when rates are not as low. And so real estate prices have to adjust by coming down. Of course, that exposes a lot of problems because real estate is collateral for a lot of loans. And if the real estate prices go down, well, the loans go bad, right? We know that. We've seen that movie. Commercial real estate also is a huge house of cards because when people buy commercial real estate, it's like a bond. You're buying the rental income, and that income is worth more when interest rates are lower. The lower the interest rate, the higher the present value of rents. And that is built into the price of the commercial real estate. And a lot of that commercial real estate is also collateral for a lot of loans. So the entire real estate market was a house of cards, right? Built on this foundation of 0% interest rates, which is no longer there. So you remove the foundation, whatever was built on top of it comes collapsing down. And so that's what's happening. Now, you also have inflation, though, right? And inflation can make real estate prices go up only because it makes the value of money go down. And so you have counterbalancing forces. You have inflation that will push the price of everything up, which would include real estate, but you have rising interest rates that are going to push the price of assets that are a function of interest rates down. And so, it's a mixed bag. A lot of it depends on where the real estate is, what kind of real estate, it is, and a lot of that as far as what's going to happen with the real estate market in this high inflationary environment that favors real assets, right? Real estate is a real asset, right? And so, you also have the leverage. But what I like are assets that are not a function of leverage, right? Maybe like commodities or like gold, right? That wasn't bid up based on the cheap money. But the way people will end up making money on their real estate in real terms are the people who were smart enough to lock in a 30-year loan at 3.5%, and who still have maybe 25 years or so left on that mortgage. They will make a lot of money, not as a homeowner, but as a debtor, because they're not going to really have to repay the money they borrowed. And so, that means that the house that they're getting, they didn't get it for free, but they got it for a fraction of the real price that they paid, right? And it means the lenders who loaned them the money are going to take huge losses, and those are the banks, right? Who do they think owns, or the American taxpayer, right? That is on the other side of these mortgages. Yeah, I don't care how you want to dress up Bitcoin. It isn't digital gold, right? So it's got nothing to do with gold. But yeah, gold did go on to make an all-time high. It got above 2,000 after we spoke. Bitcoin didn't come near making another all-time high. The record high in Bitcoin is close to 70,000. And so even though Bitcoin had a big recovery from that 10,000 level, it did not recover to new highs like gold did. And gold today at around 1,970 is very close to its record high. It's not that far below it. So if you bought gold at an all-time record high, you're not losing that much money. But if you bought Bitcoin at an all-time record high, you've lost more than half your money. So they're very different types of assets. I think going forward, gold is going to shine as a store of value, as a monetary alternative to fiat currencies. And I think Bitcoin is going to be seen in a different light. I think that Bitcoin is a speculative digital token that rose and fell and rose and fell. But I don't think it ultimately has anything to do with gold, despite the fact that some people have confused it for some digital form of gold. Bitcoin rallied just like, the NASDAQ rallied. A lot of stocks are higher than they were when we spoke a couple of years ago. The interesting thing, though, is recently, like last month, for example, you had a huge month. The NASDAQ was up about 6%. The NASDAQ 100 was up 8%, and Bitcoin got clobbered last month. So it's kind of decoupled from the NASDAQ. And so if Bitcoin's not going to go up with the NASDAQ and it's not going to go up with gold, then what's it going to go up with? Maybe nothing. Maybe it's just going to start going down. But, I wanted to talk to you, and I reached out to you too about, the Bitcoin community is now like real excited because they think I joined the club. I just think that the degree that there's speculation in Bitcoin is much higher because, Bitcoin is all speculation. It's 100% speculation because there's nothing actually there beyond the speculation. Right? So you have other things that are less speculative. Gold stocks, there are many things that you speculate on when you choose to buy a gold mining company, in addition to what happens to the price of gold. That's just one aspect of it. There are a lot of other risks that are inherent in operating a gold mine, right? So all of those risks are going to weigh on the ultimate value or price of a gold stock. So you can't invest in gold stocks unless you are comfortable assuming those risks and speculating on all these various outcomes that may or may not happen that would result in a gain in that stock. But, Bitcoin, it's all speculation. There is nothing to fall back on that is not speculative. And so gold has a lot less risk than a gold mining stock, right? Because, the only risk you have really, if you own physical gold and you have it in your house, the only risk you really have, other than the fact that you could lose it, which is, you could, or somebody could steal it from you, right? But it's the price. Will the price go up? Will the price go down? And so that's a lot less to worry about than operating a gold mine, where all sorts of things could go wrong. The price of gold can go up and you could lose 100% in your gold mine, right? So, there are a lot of aspects there. But that's why, when I tell people should invest in gold stocks, diversify, hire an expert. That's, when I formed my gold fund, I didn't even manage it. I hired a guy that knew more about it than me, right? Adrian Day. I know enough to buy gold. I know enough to invest in gold stocks, but I don't know enough to know which ones are the best, especially when it comes to the junior miners. And so I want to hire a guy that does nothing but analyze these stocks and is very familiar with the managements and the projects. And, Adrian's been doing this 30, 40 years. And so to the extent that you want to speculate on gold stocks, and to me, I think it's a great speculation. I think the risk reward, and that's always what you want to look at. Whenever you're speculating, you want to try to balance, okay, if I'm right, how much can I make? If I'm wrong, what can I lose? And try to figure out the possibility, assign a probability of success versus failure, and kind of weigh the expected outcome, the return. And I think on a risk reward basis, the amount of money that you can make in the mining sector, if I'm right about what's going to happen, is so skewed relative to what you could lose that it's a great speculation to make. That doesn't mean you can't lose. You can. But I just think the probabilities and the potential skewed reward to risk is worth it if you can afford to lose money. Some people can't. Some people, doesn't matter how much they might make. They just can't lose anything. Well, in which case you can't get in the sector. But, we have other investments, right? I manage money for people in just basic dividend paying foreign stocks that I think are also good inflation hedges. They don't have as much upside as a gold stock portfolio, but they have significantly less downside. And in the short run, they'll pay more income. You'll get higher dividends, which also offsets the risk because you're getting compensated with current income that you can use.
Small ebook, big impact, the wealth tree. The only 4 ways that will make you financially free forever. Download it here for free.